Welcome back, traders and investors. We have Chris Temple on the line, and he is editor-publisher of the National Investor. He sees his role as dispensing knowledge to his subscribers, not just information. He understands the markets and tries to make them easy to read. So, Chris, good Labor Day weekend for you?
Oh yeah, how about you, bud?
Yeah, a little football, a little sun, a little swimming. So ready, raring to go here on Tuesday. So looks like we're getting a little bit of relief rally here in the markets at the end of last week. Always looking at the macro and the geopolitical risks that are in the market. Over a 3-day weekend here, nothing much happened here. So what's your take on the market trading up this morning?
Well, it's the Alfred E. Newman market. You know, Alfred E. Newman said what? Me worry?
What?
And
Yeah. What do you read Barron's too? Because
yeah,
that,
I do.
yeah, that
I don't
was
think that's original to either Barron's or me, though. A lot of people have made that observation that this is, you can call it that, you can call it the Teflon market. You know, you've got Ukraine claiming that Russia's invading. You've got Mr. Barroso, head of the EU Commission, saying that we're approaching the point of no return. You've got ISIS, you've got Libya deteriorating anew, and traders don't care. Interest rates are compressed. You got to do something. They're all buying stocks, and it's going to continue until it doesn't.
all right. So all eyes are on Draghi on Thursday here, and the panacea for the U.S. economy was QE, and now. He looks to put it in motion over there. I mean, is that going to have the same kind of effect? I mean, we different economies and everything. You think Draghi is going to deliver on his pledge to do whatever he can to kickstart the European economy?
I doubt that, Joel. First of all, people need to keep in mind that the European Central Bank's balance sheet, on contrary to most of the rest of the ones of central banks in the world, has been contracting now for a couple of years. They need to do something, but he's stuck in a variety of ways. Number one, Germany remains very resistant to any idea of a Fed-style QE. Number two, there are new legal challenges to the ability of Draghi to do that and other things in the first place, and I think he's looking over his shoulder at that. Some of those concerns I think he telegraphed recently to the great consternation of Germany when he said that, you know what, we've got these sanctions, we've got a lot of structural issues here in Europe, and maybe the powers that be, the politicians, need to look at the situation and have a little bit less austerity and use fiscal policy to try and goose the economy. So, as much as the markets think they're going to get some manner of QE, and they still may in the end if everybody panics and things continue to deteriorate, I think he's trying to dial down those expectations, is how I see it.
So how do you play it? I mean, it seems like a lot of it is built in that it's a foregone conclusion. Do you think if Draghi cannot deliver, it'll put a drag on the European markets and the U.S. markets, or they just shrug it off and say he'll come back another day and get it through?
Well, they'll probably do the latter because the propensity of traders now, certainly here in the U.S., is to want to find any excuse or whatever to buy. But I've told people recently to take a small initial position shorting European equities, even before all of the sanctions were making things worse. That continent has a myriad of problems. Its banking system has never recovered after the Great recession and after the 2008 financial shock, the way our banking system has. Things are going from bad to worse. The sanctions are making things even worse. And, the people over there, in my opinion, and the politics of the whole Ukraine and European battle is a corollary story to this, but looking at it simply as a market and economic thing, I mean, there is no good reason to want to be bullish on Europe, whether Draghi's going to do QE or not.
Okay, looking to the other big news event of the week, we do have some secondary earnings, but on Friday, the big jobs number, the non-farm payrolls, looking consensus estimate here at 220,000. Looking for the unemployment rate to go down to 6.1% here. Obviously, that will give some kind of a cue for what's going on with interest rates. How are you positioning yourself ahead of this Friday's job number?
Well, my belief is whatever the jobs number turns out to be on Friday, one of my big themes in the recent past, Joel, is that contrary to what the expectations have been at various times since the beginning of the year, or even late last year, I just don't see any significant increase in interest rates coming. Interest rates are compressed all around the world. Maybe in Europe, some of it is because people are trying to front run Draghi in case he does come out with some kind of a QE. But the global economy is sick and getting sicker. It's not as bad here, but we're going to get dragged down into this eventually. And interest rates are going to stay down. So you have to play that by being long treasuries. You can look still out there and find a lot of really good, reasonably valued companies with decent dividend yields that you're not going to get into trouble with. I tell people a lot, maybe you and I have talked about this before too, Joel, that the first rule of an investor is kind of like, part of the doctor's oath. First, do no harm. And investors need to be asking themselves now, what is going to happen a few years from now? What trends can we see? What companies can we see that we're going to get into the least trouble with? And follow that. But let me add one more thing on that. Not
Sure.
only do I think interest rates are going to stay down, I'll tell you one thing I'm looking at though right now, and I'm a little bit worried about, is this breakout in the U.S. dollar index. I think to some extent this is a type of thing, all else being equal, that might help Europe and help some other countries that export. But if the dollar were to go up too much, you're going to start to undermine some of the emerging markets, because the benefit that they will have with their currencies being a little bit cheaper to the dollar will be outweighed by capital flight. And I had to pay attention to the fact that in the month of August, we saw some pretty strong net outflows again from emerging markets. So I question how long the Fed wants to talk tough from time to time if it's going to push up the dollar so much that a lot of carry trades are going to be unwound and you're going to have a big problem with emerging markets.
Okay, Hurt Capital is piping in. He says Spain, Portugal, and Italy are showing outright deflation right now. So he kind of looks at that as like a positive for QE in Europe. What's your take on that?
Well, again, if you look at all of the reasons why the Fed embarked on QE, no question. I mean, it would be a no-brainer for Draghi to do the same thing, especially with the European Central Bank's balance sheet having contracted. But he's under some pressures that the Fed is not, including from Germany. And again, to this point, everything that Draghi has done that a lot of his detractors have said is illegal under the Maastricht Treaty, he's gotten away with. And he's gotten away with it because time and again he's used one single magic word, and that magic word is temporary. In other words, he can't permanently do things like underwrite sovereign debt, bail out individual countries if it's a permanent thing under the Maastricht Treaty, but if it's temporary, oh, well, we'll let him get away with it. Germany's Supreme Court has backed that. Now there's a case before the European Court of Justice, and they'll probably come up with the same thing. But I think that that's one of the issues that doesn't get a lot of attention. It's at least giving him some pause.
Okay, just going back to what you said before, and maybe I missed a segue there, but you said, investing in treasuries, and then you just kind of skipped over and you started talking about high paying dividend stocks. So basically, have these dividend stocks in the market are pay have they, I mean, is that replace does that have the same security of the treasuries? I mean, where are you going to get yield except in some of these, your Johnson and Johnsons, your Procter and Gambles? I mean, that are you saying that they are your substitute for yield now?
I think to some extent they are. If you remember earlier this year, we went through a period where a lot of the high flyers got hit for a while, the biotech stocks got hit for a while, but the good dividend payers really had excellent returns, and I think we're getting back into that mindset. You look at a stock like CenturyLink, it's still got a dividend yield well above 5%. The telecom sector is looking better now than it did for a while. One company I love in the energy services area that I just added to my list, it's as good a growth story as it is an income story, is a little company in Oklahoma City called Compresco Partners. GSJK is the symbol. That thing's got a dividend yield north of 6.5%. They just doubled the size of the company, and they provide a variety of services for both conventional and unconventional production of both oil and gas. It's really not dependent on oil and gas prices. They're a service company. So there's a lot of different opportunities out there. And if I'm correct in my big picture view of things, Joel, and we start to run into trouble even with the U.S. market this fall, the realization comes about that the whole world is going to be slowing down, and the U.S. may still continue to do relatively better, but we're not going to be setting the world on fire either. Then I think investors are going to be forced again, as we saw earlier this year, to be a little bit more careful with the momentum names, the stocks that have PE ratios in the stratosphere, and look at some solid companies again, which during the summer were kind of discarded once more.
Going back to the CTL, is this something that you hold in your portfolio, or is this something that you're just looking to add to it
Oh
now?
no, yes, I recommended CenturyLink back earlier this year,
So,
and it's
so
had a really nice run. The news that came out recently with Windstream, where they're going to take some of their assets and put them into a REIT, I think that has reinvigorated, for a variety of reasons, the whole telecom sector. I think a lot of the capital gain, as far as the price is concerned, has already been logged, but I still think the stock's got some modest upside, and especially if I'm correct that long-term interest rates are not going to be going up measurably anytime soon.
now it when it had that really unusual move, I remember when that Windstream news came out as far as them transferring to a REIT. I mean, that thing made a move that I don't know if it's ever made a move like that before. I mean, I remember trading up 5 6 bucks in the pre-market. When you see something like that, it does it did it tempt you to ring the cash register on it just because it was such out of the norm, or sell calls, or do you just say, hey, that's great for my stock, and you just put it back in the drawer and forget about it?
What I did tell people to do that morning, when early on it had gapped up and it was as high as 45 or 46 bucks, I told people not to buy anymore, to go to a hold. I still like the story. It fluttered back down to the upper 30s. Now it's about 41. And I think people can still, if they don't have a big position in it, be buying a little bit of it.
Yeah, Dennis talks about a lot of times that when news comes out on something and you get a move and a big spike, and then then the luster actually wore off that day, and it comes back down to the level before the news came out. Here was a perfect illustration of that. It broke out above $38 and had the move up. Boy, how high did that thing get? I mean, I know it even traded higher in the pre-market, but that
Right.
day it traded all the way up to 45.67, and then 6 7 days later, it drifted all the way back down under 40 bucks. Not enough to fill the gap, but and now it's trading back higher. I just want to touch with you, on the gold market here, and no big action overseas over the weekend, and they're punishing gold on that. Now, you did give us a good gold stock. It was a Canadian gold stock, and it was like Seabridge or something like that. Do you remember what you?
That's Yeah. It was Seabridge. The symbol is SA.
Okay.
It's had a monstrous run.
Yeah, look at that. You did
Gold.
that, Chris. You did that. The day that you were on our show, I'm telling you, I know exactly when you were on this
Yep.
show. And our options house people got very active in it. And I remember that thing. I looked at it and I'm like, huh, if that breaks above $10, this could be a breakout. And then, holy smokes, it broke above tens, had a couple spikes up. Why is this thing kind of going contra to the gold market?
Well, first of all, what's interested me in the recent past, and I'm philosophically, I'm a gold bug. As a practical matter, I'm not. I have to call the markets as I see them, and unlike a lot of people who get overly religious on gold, I'm not going to go and step out in front of a moving truck if the market's going against me. And right now, gold is kind of an also ran. The dollar is strengthening a lot. That's hurting it. The stock market is near an all-time high. That's hurting it. There's still a lot of complacency. That's hurting it. But gold stocks, even generally speaking, have done fairly well in the recent past. And I think a lot of it is because We ended last year with people thinking that the end was coming for gold. We were down below $1,200 an ounce, and most mining stocks were down 50 to even 90% in the case of some juniors from their highs of 2011. It was like the world was over. And the philosophy now seems to be that, okay, maybe we're not going to go down like Harry Dent's and some others say to $700 an ounce or $400 an ounce. Maybe some of the worst is over. Even Goldman Sachs recently came out and modified their more bearish calls on gold. They even added Barrett Gold to their conviction buy list. So the sentiment, generally speaking, for miners has been better than it has been for the metal itself. But in the case of Seabridge, you've got a company with nearly 50 million ounces of proven and probable gold reserves up in British Columbia. That is more than just about any place else on the planet. They just got clearance from the government in British Columbia for their big KSM project, which has about 38 million of those ounces, plus a few 100 million ounces of silver and a couple billion pounds of copper. And to me, Joel, even though I'm still ambivalent in the near term about the gold price, I'm actually a little bit bearish right now about the copper price. Long term, I think all these metals are going higher. And you've got a company in Seabridge that twice in the last 8 or 9 months, when they've had to raise money, they sold stock at about 25% over what the market price was. You've got a lot of people that love this company and this play and this resource that they have. And to me, if you want, you guys talk about options a lot on this. Owning a few shares of this stock and buying it a little bit more on weakness is, to me, the best long-term call option, if you will, on gold of any company I know of.
One of our listeners here, One More Shot, says he's been in and out of SA since you mentioned it on the show last, and that's why he loves the show. So great tip on SA. Just the final minute here. S&P futures currently trading at new all-time highs. Quiet over the weekend. The event's coming on Thursday or Friday. Is there any reason for investors to be looking at some hedges or taking some chips off the table ahead of the news this week?
Well, I still am a little bit leery about trying to short U.S. stocks because anybody that's tried to do that to any great extent, you just get run over. Like I said earlier in the show, I think that the European stocks, I've initiated a small short position there, and I'm holding back for now. But if I were to see after Friday a dollar spike for some bad reason, whether it's people get their worries about the Fed up again, whether something happens overseas. I think that the emerging markets are going to be the next place where if I wanted to try and bet against the complacent attitude now, that would be the next place I'd look.
Okay, Chris Temple, editor and publisher of the National Investor, giving us a very educated, well-rounded view of the markets, both bullish and bearish. Chris, I really appreciate that because you do. Of all the people that we have come on the show, everyone's bull, bull, bull. But you talk about areas of that your potential shorts and stuff. So keeping an eye on both sides of the market. That's what we try and do here on our show. Thanks for coming on, Chris. We hope to speak to you again soon.
My pleasure, Joel. I always enjoy it.